This is video 3 of Audible. We are having a look at the solution, and the first thing we need to look at is how the transaction price is allocated between the two performance obligations. So the two performance obligations that were correctly identified is the Amazon Echo spot that was provided, and then the audio credits that they used to buy the audio books. So we allocate our transaction price to each of those performance obligations based on their standalone selling price. So the Amazon Echo Spot standalone selling price is 1,040 Rand, and the audiobooks is 120 Rand for the subscription for 12 months. That is what it usually costs, not on the promotion with the discount, but what it usually costs. So then we can calculate what is the proportion of the total transaction price that belongs to the Amazon Echo Spot by taking the standalone selling price of the Echo Spot divided by the total of all the standalone selling prices and multiplying that by the transaction price. Now, what is the transaction price? The amount that you think you will be entitled to. What will we be entitled to? 120 Rand a month would be without the 10% discount, so times 90% because of the discount, and that is per month times 12 months. And this is now for one subscription. So we haven't multiplied it yet with the 10,000 subscriptions that were received. So in this way, we can calculate what is the portion of the transaction price that goes to the Amazon Echo Spot per subscription. If we then want to calculate what is the portion that goes to the audiobooks, we do the same thing. We take the standalone selling price divided by the total of all the standalone selling prices times the total transaction price, and that will give us per subscription what is the amount allocated to the performance obligation of the audiobooks. So what was done incorrectly was that revenue was recognized for the full amount of 1.2 million, a promotion expense and bank were recognized. We have looked at what should have been done, and you will see that the two bank amounts are identical. You could recognize the bank amount, it's the same amount, no error there. What is not correct is the promotion expense. There should not be a promotion expense. Revenue should be less. You are not allowed to recognize revenue for the full amount if you don't think you will be entitled to the full amount. So that promotion expense needs to be taken out, and that is why in the note we have a decrease in other expenses. That is the promotion expense. Then we should have recognized revenue from the Amazon Echo Spot. That is the performance obligation that is satisfied. That is the control that is transferred. That is what has been delivered. So revenue should have been recognized for the Amazon Echo Spot. Revenue should not have been recognized for the audiobooks because no audiobooks were sold. So the amount that was received in December for the audiobooks was income received in advance, and that is a liability. So that is why we see a liability and we see trade and other payables. That is the income received in advance because we cannot recognize revenue yet. We have not sold any audiobooks. Then we also need to recognize a trade and other receivable, either a debtor or contract asset, for the full amount of the Amazon Echo Spot, minus the little bit that we have now already received. We have received 1 month of money, that is in December, so the debtor can get a bit reduced. So what is the balance left on the debtor or the contract asset? That is what we will see in trade and other receivables. So now that we know what was done, what should have been done, we know the amount, we can see what the net effect is between what was done and what should have been done. For revenue, there is an increase in revenue. We only recognized 1.2 million. We should have recognized 5,430,000. There's an increase in revenue. We've already said there's a decrease in expense because of the promotion expense. Bank stayed the same. Increase in the debtor, the contract asset, the trade and other receivable, because that was never recognized. And then also an increase in income received in advance, which is a liability. Retained earnings will also change because there was a change in profit for the year. So retained earnings changes with that same amount. It is also the same as assets less liabilities. The balancing figure should be in equity.